Hello there, everybody. Thank you so much for joining us this afternoon for one of our weekly webinars here at the Retirement Group. My name is Sam, and I am Client Services here. I moderate these weekly webinars. In just a minute, we are going to be joined by our advisor, Wesley Boudreaux, and he's going to be speaking to FedEx employees about whether to take the lump sum or annuity option when retiring from FedEx. But before I bring Wesley on, I would very quickly like to remind you that although we work very closely with both active and retired members of FedEx, the Retirement Group is not affiliated nor endorsed whatsoever by FedEx. We are a completely independent group of financial advisors, so please keep that in mind. After Wesley's presentation, I will rejoin him very quickly to ask him any of the questions you may have entered into the Q&A chat throughout his presentation. Please feel free to ask away. It is 100% anonymous, and Wesley will answer as many questions as he can, time permitted. And now I'm going to turn off my camera so Wesley can get started. Hey, Wesley.
All right, thank you. Appreciate that introduction, Samantha. So yeah, as she said before I kind of jump in there, we are an independent financial advisory firm, and the great thing about that is independence. So we're not tied to any specific firm. So when we get to that specific planning phase and talking about different options for you, that's going to be unbiased, and our goal is to kind of back into things and walk you through that process. But for those of you who do not know who we are and haven't sat down with us in a while, a quick refresher of who the Retirement Group is. As I just said, we are an independent financial advisory firm, a group of advisors across America that focus on helping you transition into retirement. So what does that mean? Our niche area is, again, understanding the benefits plans for a lot of these different Fortune 500 companies, whether it be the pension, the 401k, healthcare retiree medical benefits, life insurance extension benefits, things like that. So our goal is to hopefully catch you prior to retirement, maybe 5 years or so. In some case, it may be 5 weeks or it may be 10 years. But we're here to try and help you understand your benefits. So as you transition to retirement, you can maximize those benefits the company gives you and help you determine really the best day to retire and how to actually choose some of those different benefits. We'll talk a little bit about that today as far as the pensions. Some of you have options instead of just the single life annuity, you have different options like lump sums. And we'll get into that and how the interest rates affect that as well. And we do have offices across the nation. So if you need to sit down with somebody face to face, we can likely accommodate that. But obviously, this day and age, we can help you out any way you want, whether it be sitting down doing a webinar like this, web meetings, phone calls, email communication, whatever your preferred method is. Just let us know. At the end of the day, if there's anything you take us up on, it's take us up on our complimentary cash flow analysis. This is something that's going to be more unique to your specific situation and your company retirement plans to help you determine, again, the right day to retire. A lot of times people come to us and say, hey, Wesley, I'm looking at retiring at 59 and a half because I know that's when I can start tapping into my account. Or I'm retired at 62 when Social Security starts, or at whatever age it may be when my son graduates college. Those are all kind of the soft answers, but our job is to get into those financial answers for you and let you know, do those line up, or does that make sense? Should you retire earlier? Should you work longer? We will not shy away from telling you, hey, we run the numbers. You need to either cut back spending or maybe work a little bit longer. So we'll get into all that information with you, but ultimately the goal is to determine the best day to retire, how it correlates to your specific company plan. And that also helps us lead into the financial decisions as far as how to manage a portfolio if you're hopefully throwing a hat in the ring when it comes time to working with an advisor post-retirement or prior to retirement as well. So as far as today, we're going to talk about the pension plan and how that can be differentiated across some of these different companies we work with. Like Samantha said, we work with a lot of different Fortune 500 companies, and they're all slightly different. But at the end of the day, a lot of the ones we work with still have pension plans. So count yourself lucky if you're on this webinar and you are at a company that does still have a pension plan. Over the last decade and a half or two, a lot of these different companies have either frozen their pension plans or walked away from them, transitioned into better profit sharing plans and things like that within a 401k. But generally speaking, there's really two types of pension plans you're going to see. There's the classic defined benefit plan, which is a formula-based plan in order to determine what your single life annuity is going to be for the rest of your life. Then from that, all the other calculations are calculated from that specific number. So a lot of those formulas, they're going to be different from company to company, but they typically are going to look at, a multiplier times your final average earnings, times your years of service. And a lot of times they have a Social Security offset. So they run those calculations and come out and say, okay, Bob is going to get $3,000 a month for the rest of his life. Then from there, we look at those different other options. And there also could be a cash balance plan. So for a lot of newer employees, maybe in the last 10 years or so, the company may have a cash balance plan. It's a little bit different where they give you a specific percentage. Maybe it's a 6% contribution each year Usually it's going to be tied to treasury. So we haven't had much growth in that in the last couple of years, or maybe the last, decade or so. Now, finally, we're seeing this inflationary pressure move short-term interest rates. So you are seeing a little bit better growth out of those. And then from that side, that's essentially kind of like starting with a lump sum. You can back into calculating out the other options you have there as well. But just give us a call. We'll be able to tell you what your pension plan is and how you're affected. Because there's also some companies where you may start it with that classic defined benefit and then transitioned over to a cash balance. So you've got two different pension plans to look at. So let's go to the screen here. There's really a couple different forms of payment you may see. Like I said, the normal or original payment is going to be that single life annuity. And then you have the option potentially to do a joint survivor with either your spouse or significant other, in which case he or she can get continued payments if you pass away first. We'll talk about some of those options. The lump sum is what we're going to talk about as well, because that's what a lot of people are concerned about with these rising interest rates, how that's affecting it. And we'll talk about the look back period, which essentially is kind of how different companies use those interest rates to determine what they're going to pay you in that lump sum calculation. So that single life annuity, I kind of talked about this already a little bit, but on that normal defined benefit plan, if we go in there and we talk about a calculation, again, the final average pay, years of service, a multiplier, social security offset, I'd used I used Bob as an example before. So we go through there and we come out and Bob is going to get $3,000 a month for the rest of his life. Let's pretend Bob is 56 years old right now. So again, he's going to get that $3,000 a month for as long as he lives. Now there are some other, not many companies do this, but there are a few companies that do have what's called like a uniform option, in which case they will pay you a flat amount and they'll adjust that for Social Security. So let's go back to Bob's example. Let's assume that maybe $3,000 a month was what they were going to come out with, but at 62 he's got the ability to turn on Social Security for $1,000 a month. So maybe they pay him $3,000 and then it drops to $2,000 at 62 because he's going to get another $1,000 from Social Security. So it's a uniform income table. Those are kind of interesting to look at. So if you have any questions on there, let us know. There's not that many companies that still do this as well. But again, it pays a fixed amount. There's no cost of living adjustment in there. And God forbid something happens to Bob in this case in 5 years, then it's over unless he puts what's called a period certain on there. So there are options to do what's called a period certain, where you say, okay, I want the single life annuity with a 15 or 20-year period certain. Most companies max it out 20 years. So in that same case I just mentioned, Bob, let's say instead of getting $3,000 a month, he might get let's say $2,850 or something like that, or $2,900 a month, because now he's got a 20-year period certain on there, which means the company's got more risk of paying out for at least 20 years. So in that case, the benefit for Bob is he knows he can calculate out, hey, $2,900 times times 20 years, I know exactly what I'm going to get, or my family's going to get in case something happens to me earlier. If I make it past 20 years, then great, I'm going to continue to get my payments. So that's another aspect we want to review when it comes time for those. Now, if you are married or have a significant other that you want to take care of, then you can do what's called a joint survivor annuity. And again, every company is slightly different in this. Usually most companies are going to be 25, 50, 75, or 100% continuation. I've seen some that give a 1% continuation, which is honestly a slap in the face, but I think it's really they just give you the option of 1% to 100%. So you can break it down any breakdown you want. So if you want to do 76% or 55%, you can do it however you choose to. So same situation where I mentioned that period certain. In Bob's case, let's go back to that. Instead of getting $3,000 a month, he's not going to get that much because if he's married and they're paying out over the potential to life, then let's pretend his spouse is going to be the same age as him. There's a greater chance of one of them living longer than the other. So there's a greater chance that the company is going to pay out for a longer period of time, and especially if the spouse is younger. Now the companies take this into account when they run the actuarial tables to figure out what they're going to do. So let's say for Bob, instead of let's say if he wanted to do that, instead of that $3,000, he might have a joint survivor annuity with 100% continuation at, let's say, maybe $2,500. So what happened is if he passed away in 10 years, his spouse would keep getting that $2,500. Maybe it was instead it was $2,800 with a 50% survivor. So what would happen is if he passed away, he stops getting the $2,800, the spouse gets 50% of that, so $1,400. So again, a lot of calculations that go into this, and this is where it's really kind of important to sit down with us and kind of talk about those options and really what you're trying to plan for. But none of these usually have a cost of living adjustment on there. So that's another aspect to be aware of. That's where a lot of times that lump sum calculation comes into play. where a lot of people look at that because they have the ability to potentially outperform that pension annuity because they have the ability to get cost living adjustments based upon market performance or how they invest. But there are definitely pros and cons to that. So again, this is something we can go over on a one-on-one basis based upon your specific situation. But to be real quick, if you've ever had gambling problems or spending problems, or if you've got relatives that are going to come knock on the door asking for help and you can't turn them away, that's one reason probably not to have the lump sum, because when you get that big bump of assets in your IRA, you may have a risk of spending through it. Or if you are not good at managing money on the investment side, if you're going to do things on your own and you're too risky, you can run the risk of reducing that. Obviously, if you work with a firm like us or others, then you can look at backing into a sound investment philosophy to try and achieve what you're looking to do. And going back to Bob's situation, the benefit of that lump sum is, let's say, God forbid, he does pass away in 7 years. And so the company keeping the rest, now he's got the ability to pass that on to his beneficiaries. There's a lot of other planning mechanisms you can do there. It also gets into some tax planning strategies as far as reducing RMDs and stuff like that down the road, and reducing the potential high tax brackets you could see with fixed income payments. So we can get into all of that with the cash flow analysis. But how does that calculate? So how do I know what my lump sum is going to be? Well, every company is different, but there's different ways they do this. But specifically, the best way, or excuse me, the main calculation is going back to Bob's example. Let's assume he makes $3,000 a month for the rest of his life on that pension. He's 56 years old. So what they do is they go out and say, okay, well, life expectancy right now is 86. So we've got to pay him for 30 more years, hypothetically. So we have to do a net present value calculation to determine how much I'm going to pay him in order for him to essentially go out there and try and recreate that same $3,000 paycheck on his own. Now, when interest rates are higher, they're not going to have to pay him quite as much, because if he's got let's say $100,000 or let's say $500,000, growing at 6% versus $500,000 growing at 3%, they don't have to give him as much money. And we'll go over that in just a moment, how those are affected, and look at how these interest rates have changed here recently. So actually, I'm sorry, let me jump ahead. So here's a great example of the difference of those interest rates. So basically what's going to happen is when interest rates are higher, you're going to get a lower lump sum. Think about it like a mortgage. When interest rates have gone up like they have here the last year and a half or 2 years, your buying power has been limited as far as mortgages. And this example we have here is not as close as what they are right now. Unfortunately, we've seen interest rates go up a lot higher than that. But in this case, let's assume 1950 is what Bob's single life annuity was. And if interest rates were 3% on that right-hand side, he'd get a lump sum of 462. Now, if they went up to 4%, so just that 1% change, he's getting about 408,000. So same situation. If you could only afford 1950 a month for your mortgage, with higher interest rates, you could only afford a $408,000 house, whereas a year or two ago with lower interest rates, you might could afford a $462,000 house. So that's kind of the example of how those interest rates work. And every company is different as far as how they look at those interest rates. So what's going to happen is
Hey, Wesley. Sorry to interrupt you. I just wanted to let you know we're getting some really, really great questions in today. I wanted you to start kind of thinking of these so we can answer them when you're done with your presentation. But the first one that we just received, can I defer my pension once I retire and wait until the rates drop in the future? So that's the first question.
Okay. Yeah, I think the next 2 slides, or maybe the next slide, we're going to show some rates, what they look like. So I'll address that there if I can. Generally, it's going to depend upon your company plan, but a lot of the company plans we work with do allow you to defer that. But I'll make sure to kind of focus on that on the next slide as well. So going back to the look back period, and this is where a lot of these interest rates are factored in. So every company is different. A lot of the companies we work with, some do either a one year rate lock quarterly, or some do it on a monthly basis. So usually what they're doing is they're looking at the PPA segment rates, the Pension Protection Act segment rates, to determine what your single life annuity is going to be. So again, not to beat a dead horse, but go back to that Bob situation. So in his $3,000 a month for the rest of his life, what they'll do is they'll go and say, okay, we're on the hook for 30 more years in this case. And what's the interest rate? And that's what they're going to do, and go back and look back and find out what interest rate do we use, because they don't know what the future interest rates are going to be. So the ones that use it monthly, that could be as recent as like 2 or 3 months old. The ones that do it quarterly, it could be 3 or 4 months old. The ones that do it annually, it could be a couple months old if you're commencing in January, or it could be a year old if you're commencing in December. So what they'll do is they'll lock in. So some companies may use the September interest rates for all of the following year, or November interest rates for all the following year. Some will use an average of all 3 months in their prior quarter. Some will use an average of just the last 2 months in their prior quarter. Some will just use the last month of the prior quarter. Some will use an average of 3 months on a rolling monthly basis. So they're all different, but the whole goal there is so they can kind of figure out what is that net present value calculation going to look like? What interest rate do we use? We don't just throw out an arbitrary 5% or 3%. We want to try and keep it up to date with the segment rates. And I'll go over what those segment rates are in just a moment and kind of how they've moved here as well. Now, there are some companies that if you've been there for a pretty long time, maybe you're over 65, 66 or so, been there for 30 years, that may still have what are called the GAT rates, which are tied to the treasury, which is actually typically going to be a lower interest rate and generate a higher lump sum. But again, we get into all those weeds when you give us a call to kind of run that cash flow analysis as well. So let's get to some of these rates, and I'll answer that question that Samantha jumped in on. So most companies use the PPA segment rates. So those are the Pension Protection Act segment rates. Usually what they're going to focus on is 3 different segments. The first segment is going to cover, generally speaking, the first 5 years retirement. Second segment is going to cover years 6 through 20, so about 15 years there. And the third segment, years 21 and beyond. So depending on how old you are, it could be a couple years, it could be 10, 15 years. So it all depends on your age as to which one has the highest weighting or bearing on your calculation. But for simple math, the second segment has 15 years in it, so that's probably gonna be the highest weighting for most of us. So we look at these interest rates. We've got a couple in here. So October going back to June. I'd like to actually show this farther back. So we go back 2 years, those interest rates in that second segment, we'll focus on that. We're in the 2% range, the lowest we've ever seen. Now we've had the biggest, quickest climb we've ever seen, and we're at some of the highest interest rates we've ever seen here. So if we look at that first line for October, the first segment is 5.77%, 6.14%, and 6.19%. If I just go back a couple months, the bottom of that screen, June, let's look at the second and third segment there. So that second segment was 5.23 and 5.16. So on that third segment, we're up over percent change. Second segment, we're up getting close to a percent change, about 90 basis points or so. So why is that important? If you look at that seesaw slide on the top, when interest rates go up, your lump sum is going to go down. Vice versa, when interest rates go down, your lump sum will go up. So we saw that in the pandemic. We saw interest rates get a little bit artificially too low. And now that pendulum has swung, and it swung pretty severely to the other side. So hopefully we'll see this. The Fed has started leveling off rates, and hopefully that will lead to some of these bond rates, which are used for the PPA segment rates, to follow suit. And we'll hopefully start to see those level off and maybe come down a bit. By no means should we see them go back to where they were in the pandemic time frame, because we don't want that to happen, obviously. But we should hopefully see a pullback here somewhere. So that gets to that question as far as what Samantha said. Can I defer my benefits with these interest rates changing? So we don't have a crystal ball, but expectations are, or hopeful expectations are, that we're getting here to the top of this, hopefully, and we'll start to come back down. So let's assume, I'm going to say Bob again, let's assume Bob in that situation, he retired, he's 56. What I didn't get into is a lot of companies, that's a little early to retire. And a lot of companies, they don't really pay you all your pension until you reach 60 or 65. So let's assume in Bob's situation, he gets 100% pension at age 60. So he may have the option, again, not every company does it, but most of them do, allow you to retire and then defer commencing your benefits. So that'd be a perfect situation for Bob if he said, hey, look, I don't want the annuity. I want to make sure that I protect my family, and I want to make sure that they get something passed on, not just my spouse, but my kids and grandkids as well. And I want control of the assets. So I want to take my lump sum. And let's assume maybe that lump sum calculation comes out to $500,000 right now, using the interest rates, whether it be last year or this year, but with these high interest rates, that's $500,000. Well, maybe in his situation, he might have a pension plan where he gets a 5% reduction each year under 60. So if he's 56, that's a 20% reduction. So even if interest rates don't change, if he decides to defer commencing his benefits and he just waits 1 year, everything else held equal, he'll get a 5% bump in that because he's 1 year closer to age 60. So he'll have a 15% reduction instead of 20% reduction. Now, best case scenario for Bob in this case would be that he waits and we also see interest rates come down. So it's a double hit where he's getting a bump for the age penalty, aging out of it, and he's getting a bump because interest rates are coming down, driving up his lump sum. So it could be the point where, in this case, we watch the interest rates and we watch them go down, hopefully, and we get to the point where maybe they go down and they start to turn back around and start coming back up, and that's the time to pull the trigger for Bob. So he might retire at 56. tap in his 401k if he needs to, because that's going to have an age 55 rule, but not touch that pension, defer that pension out. And maybe he defers it for 6 months, a year, 18 months. It depends. We'll watch it and help determine when's that best day to pull that trigger. So you maximize that lump sum from the company. That in turn is going to maximize your retirement benefit throughout the course of a retirement. So hopefully that answers the question. That was a great question, because it allowed me to get in a little bit deeper into something I was going to just basically touch on here before. So all of this, again, I've kind of put in the caveat, every company's a little bit different. We've worked a lot that are different. So really the best way to do this is to run a cash flow analysis. Give us a call to kind of dig into your specific situation. I mentioned before at the beginning, that's a complementary cash flow analysis. This is something that will allow you to see, hey, where am I on the path of retirement planning? If I haven't done anything, it'll let you know where you stand. If you have done, a lot of times we use this for great checks and balances. A lot of times we come back and say, hey, look, yeah, it's pretty close to what you're thinking, but here it is in paper. Here's the reality of it. And if we tweak this or tweak that, here's how we can better it. But also it really gets into reviewing those pension options. We can run multiple scenarios saying, okay, if I retire at 60, do I take the annuity versus lump sum? Do I take the joint survivor annuity? Do I take the lump sum and buy my own annuity, or do a split strategy? There's a lot of different aspects in there you can look at. And that's another thing, going back to these interest rates. We are in an interesting spot where those interest rates going up have driven down the lump sums, but that's also driving up annuity calculations on the private marketplace. So a lot of individuals we worked with have been able to actually take their lump sum and get an annuity that's directly through them, not the company, paying a little bit more than what the company pays, but also having some different benefits, maybe a cash refund. So if something happens to you sooner in life, the rest will still be paid out. So we can always run calculations on that. But we also can back into let you know how your allocations and your 401k and go through all that. But ultimately, give us a date that you're thinking about retiring. We'll gather some data from you. Give us a couple minutes to get that on the phone, maybe 10, 15. Just about a week to put the full report together, because there's a long, 60 to 100 page report depending upon your situation. And we call that the rough draft, if you would. And we can go in there, run through that with you and tweak it and make any changes you want to see, and really help you determine the best day to retire. And that can then help it back into some investment decisions for you on the 401k plan, or or in the future if you roll to an IRA. Excuse me. All right, so I'm gonna wrap this up, see if any other questions came through, but I'll keep this on the screen here. Any questions, again, give us a call directly. Again, this was more generic, talking about different company plans. So give me a call and we can talk about your specific plan. But it's 800-900-5867. You can also send us an email at info@theretirementgroup.com. Got a couple QR codes up here. One's for the calendars. If you want to get into my calendar, one of the other advisors' calendars to try and schedule an appointment, we can do that. Just keep in mind those appointments usually on the calendar looking are about a week out, just so we don't have any last minute adjustments. So if you need something more last minute, just give us a call or email us. And then there's also a LinkedIn page where you can stay up to date on any information we send out, whether it be company plan changes, these webinars. If you want to get into specific company situations, we'll keep you updated on specific company changes, and a lot of times the interest rate updates for those annuity, for those lump sum calculations. All right, I'm starting to lose my lose my throat. So any other questions come through there?
Yes, Wesley, actually, in an effort to just respect everybody's time, we're only going to answer a couple more. Thank you for answering that first one, by the way. This next one, what is the look back and how does it work?
Okay, I think I kind of went through a lot of that on that one screen. So again, the look back is going to be what interest rate is the company going to use in order to tell you what your calculation is for that lump sum. You've got no control over this. You can't change this. So again, a lot of companies might use an annual. So the ones that use annual usually will use like the month of September or the month of November. So whatever that interest rate is, that's going to be the interest rate they use for all the following years. So for instance, the month of November, we don't get those interest rates posted until about 3 weeks after. So right around Christmas time. So it's hard for some of those companies. You don't know what it's going to be until probably last minute at the end of the year, but that's going to be locked in for all the next year. Then again, others do it quarter by quarter, others do it month by month. But again, you've got no control over this. But that's where we go to work for you, looking at those interest rates, telling you here's the calculation. Hey, you might want to retire, a quarter earlier, or defer a quarter, or you might want to retire a month or two later or earlier. That's really going to be for us to kind of get into with you to help you maximize that pension.
Alrighty, thank you. We're just going to do one more. How should I use the direction of the rates and the look back to optimize my retirement planning?
Okay. I think I can kind of piggyback on what I was just saying. I'll plug the cash flow analysis again. That's the best way to do it. So,
Right.
like I mentioned, a lot of these company plans are different. You may have a good buddy that works down the street at a different company that's got an annual lock, and you may have a monthly or quarterly lock. So it's great to talk about these things, but it's better to kind of know your specific situation. So again, give us a call, and we can run that for you. But like I said before, if we'll have a conversation about those interest rates again, we're as good as we can be, but we're not going to we're not going to know for certain every month or every year where interest rates are going. I'll tell you, me personally, I knew they were coming up, obviously post pandemic. I didn't expect them to come this high and this quickly. So what that hopefully is telling me that pendulum kind of went one way for the pandemic, it's going the other way now, and we'll start to kind of teeter totter in and get back to averages. So again, it may be a month or two down the road. It may be 6 or 7 months down the road. We should level off and we should start coming down. So that's definitely a great conversation to have on, hey, can I defer my pension, watch these interest rates, and we maybe will do it month by month, quarter by quarter, depending upon your specific plan.
Alrighty, Wesley, that was it. Anything else you want to add before we end?
No, just again, would you reiterate what you said at the beginning? We are an independent financial advisory firm. We've been working with a lot of these companies for over 30 years. So we've got a great understanding of the benefits plans inside and out, really to kind of help you understand what those options are. But at the end of the day, that does not mean we're endorsed or employed by them. But ultimately, just any questions you have, give us a call. We can probably get to it a little bit quicker than calling HR and give you that answer, and then give you some real numbers on that planning side of things.
All right, Wesley, thank you. Thank you, everybody, for joining us today. Have a good afternoon. Thanks,
All
Wesley.
right, thank you.
Bye.